Hello and welcome to another episode of Forex Uncensored. I'm Tony, and today we're diving deep into the world of Forex trading, specifically focusing on fundamental analysis. Forex trading can be a powerful tool for financial growth if you know how to navigate it, and fundamental analysis is one of the essential pillars for understanding the market. So whether you're a beginner or looking to sharpen your skills, this episode will guide you through the core element of Forex fundamental studies, including economic indicators, global events, and central bank policies. Let's get started. First off, what exactly is fundamental analysis in Forex? Fundamental analysis is the study of factors that impact a country's economy and currency. Unlike technical analysis, which focus on price pattern and trends, fundamental analysis look at economic data, geopolitical events, and central bank policies. Think of it as understanding the big picture of the economic health of a country to anticipate how its currency may move. In the Forex market, currencies are traded in pairs, meaning we are always comparing the strengths of one currency against another. For example, if you're trading Euro-USD pair, you're analyzing the euro in comparison to the US dollar. This fundamental comparison is crucial in making informed trading decisions. So, what are the primary indicators that Forex traders should be aware of? There are several key economic metrics that can impact a currency value, and I'll go over the most significant ones here. Gross Domestic Product, GDP. GDP is a total value of goods and services produced by a country. It's essentially a measure of a country's economic performance. A rising GDP indicates economic growth and often strengthens a country's currency, while the declined GDP may signal a weakening economy and currency. Interest rates. One of the most critical drivers of currency value in interest rate is interest rate set by a country's central bank. Higher interest rate can attract foreign investors looking for a better return in their investments, which can boost a currency value. For instance, when the Federal Reserve in the United States raises interest rates, the US dollar tends to go stronger. Inflation represents how much prices are rising in an economy. Low, stable inflation generally supports currency value, but high inflation can decrease purchasing power and weaken a currency. Central banks often manage inflation through interest rate adjustment, so keeping an eye on inflation data is essential. Employment figures like the non-farm payroll in the US are also highly significant. A low unemployment rate can indicate economic growth, often strengthening a currency, while high unemployment may have the opposite effect. The trade balance is the difference between a country export and import. A positive trade balance, more exports than import, typically strengthens a currency since it means foreign buyers are purchasing the local currency to buy goods. These economic indicators are typically released on a monthly or quarterly basis and can cause immediate significant reaction in the Forex market. Central banks like the Federal Reserve in the United States, the European Central Bank, and the Bank of Japan play a vital role in the Forex fundamental analysis. They have the power to influence currencies, values, and adjusting interest rates, conducting open market operations, and setting monetary policy. Let's take a look on how this works. When central banks raise interest rates, it generally increases demand on their currency as investors seek higher yields. For example, in the European Central Bank raise rates, the euro could strengthen. Conversely, a rate cut may weaken a currency as investors look elsewhere for higher return. Central banks release statements after their meetings, often outlining their economic outlook and monetary policies plan. These statements are analyzed closely by traders for any signs of future rate hikes, cuts, and other policy changes. During economic downturns, central banks may introduce measures like quantitative easing, where they inject money into the economy by purchasing government bonds. This often leads to a weakening of the currency due to increased money supply. Central banks don't just control currencies' values, they set the tone for the market, and forex traders pay close attention to every word in their statement. Next, let's talk about geopolitical events. These events can be unpredictable, but they have an immediate and sometimes long-lasting impact on currency markets. Trade wars. When countries impose tariffs on each other's goods, it can lead to a decline in trade and economic uncertainty, impacting currency value. For instance, the US-China trade tensions caused fluctuations in both the US and the CNY over recent years. Election and political instability. Political events such as elections or changes in government policies can cause uncertainty. Markets generally don't look uncertainty, so a major election or unexpected policy shift can lead to volatility. Global crisis. Events like war, natural disaster, or pandemic can dispute economics and heavily impact forex market. For example, the COVID-19 pandemic in 2020 led to a significant shift in currencies as countries implemented different economic measures to manage the crisis. Understanding the global landscapes help you better predict how this event could impact currency values, even when it's difficult to foresee specific events. Now that we've discussed the key factors, let's explore how to actually apply fundamental analysis in your trading strategy. Keep track of when economic data release, central bank meetings, and other major events are scheduled. Websites like Forex Factory and Investing.com provide economic calendars with release dates and time for significant indicators. Set reminders for events that align with your trading strategy. Before economic data is released, analyze often market predictions and then forecast affect market sentiments. Compare forecast with actual data after release and understand market reactions. Instead of focusing on one-time release, look for patterns over months or quarters. For example, in a country's inflation rate consistently rise, this might lead to a rate hike by the central bank. While fundamentals give you a sense of the overall trend, technical analysis help you pinpoint entry and exit points. Use fundamental analysis to determine market directions and then apply technical indicators like moving average or RSI to fine-tune your trades. In summary, Forex fundamental analysis is a powerful tool that involves studying economic indicators, central bank policies, and global events to gain insights into currency movements. Also, it takes time to master. Understanding these fundamentals can set you up for more strategic and informed trades. Thank you for tuning into today's episode. I hope you found this introduction to Forex fundamentals studies valuable. If you have questions or topics you'd like me to cover in future episodes, please feel free to reach out. Don't forget to subscribe, and happy trading. Until next time, stay informed and trade wisely.